It feels like the ground is always shifting, really.
Yeah.
And it's easy to get into the mentality of, well, these are the biggest companies, they're the most powerful, they're unstoppable. But history suggests that's not how these things work.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by my Fidelity colleague, Jemma Slingo, to talk about really the most important companies in the world, the most important because they are the biggest and because investors have relied on them more than any other companies for their returns. So certainly in the last few years, at least. They're popularly known as the Magnificent Seven, of course. And today we're going to be taking their temperature. What kind of shape are they in? Do they justify the faith that investors have placed in them? And crucially, is it too late to buy them as investments? Jemma, welcome along. How are you?
I'm good, thank you.
Very good, very good. Let's start, shall we, with where the Magnificent Seven, actually, we're going to talk probably later about whether that fits anymore, that description, but where the Magnificent Seven fit in terms of the overall investing landscape. The companies we're talking about, of course, are Amazon, Apple, Alphabet, including Google, Meta, including Facebook, Microsoft, Nvidia, and Tesla. Just how big and important are they for investors?
I would say in a nutshell, they're massive. So whenever I'm writing about the Magnificent Seven or talking about the Magnificent Seven, I always feel this need to go and triple check the numbers because they basically seem completely implausible.
Yeah.
But they are right. And if you look across the world stage, so across the global market, these Magnificent Seven stocks represent a fifth of the market by value. So that's if you buy a global tracker fund, you gain exposure to well over 1,000 stocks. But a fifth of that portfolio will be in just seven.
Exactly. Yeah, I mean, the point about global trackers really highlights it. You might think you're investing you are investing right across the world with a fund like that. 5%, 6% of your money might be in something like Nvidia, if that happens to be the largest company, or Apple. They really do hold this very dominant position for investors. And that's due in great part, of course, to their huge growth. They've been driven to these great values. We've got a chart, in fact, that shows this really well, where you're going to be able to see what we mean. If you're watching us on YouTube, this will be clear. If you're not, you should get the gist, really. We can see basically the performance of the S&P 500 over the past 10 years, and alongside that, the performance of these just 10 biggest companies from within the S&P. Now, that's 10 companies. Clearly, the Magnificent Seven are going to make up a big part of that. Had you invested £100 in that main market back in 2015, you would have £300 now. Not bad.
No.
Not bad at all. But had you invested in just the top 10, you would have had £600. And that highlights the difference that we're talking about.
Yeah, I mean, it's an amazing chart. You wouldn't have been sad if you had invested in the S&P 500, you'd have tripled your money. And that doesn't include dividends. It's just a price return. But you can see the huge difference and where those returns are being driven from. It is those mega caps, essentially.
Yes.
And actually, if you look at the chart, you see these bursts of outperformance as well. It's not just a, very steady set of growth that we're seeing. You get these big shoots up and then a bit of a drop off and then another burst of outperformance. So
and there's been a couple of major instances of that in the last sort of 10 years, haven't there? I mean, COVID was definitely a period like that. Obviously, if you think back to that time, those were the stocks that people thought were somehow insulated against the pandemic because they are not reliant on, people being out shopping, for example. A lot of it is online, of course. And they just shot up really and ran well ahead of the main market at that stage. But actually there was another one, which is 2023 at the start there. Stocks in general had a bad year the year before. Things in general began to recover, but those stocks, big tech stocks, ran away. And that's a story about AI, I suppose. And really the market kind of catching up with that story and really putting the faith in AI as being a driver of returns in the future.
Yes, I think it was November 2022. That was the real crux point because that was when ChatGPT first launched. And
Yes.
I remember being in the office and everyone was just poring over this thing, amazed at what it was able to do. And I think that was the moment where everyone was like, wow, this is the new big thing. This is the next thing after the internet, essentially. And that has what's propelled stocks like Nvidia way
Nvidia
higher.
probably no one knew back then.
No, and actually I was looking at a share price chart just earlier today, and its share price had been, really quite lackluster up until that point. It had been doing well, but it had a tough 2022, as you'd said, and then after that it just exploded.
So that all tells a story, I hope is clear, of their fantastic success and growth in stock market terms up to now. What about the near future for the Mag 7? You've been writing about this, Jemma, in the past couple of weeks. Some fantastic analysis of where these companies are. By the way, I'm going to stress here that we're not here at all to encourage people to buy or to sell or to hold any of these stocks. This is just laying out the facts that perhaps might surround that decision. How have the Mag 7 been performing in terms of the money that they are actually making, not just the stock market performance, but their earnings underneath that? They really have to continue to deliver, don't they, high levels of earnings in order to repay the faith that's been shown in them.
They do. And we're just coming out of results season at the moment, so lots of companies have been reporting their half-year results, and that includes a lot of the Magnificent Seven. Not Nvidia, they have a bit of a weird financial year, so they're reporting later in August. But we've seen a lot of results from the likes of Meta, Alphabet, and generally they've been really, really good. So other than Tesla, we've had double-digit profit growth, double-digit revenue growth, lots of companies positively surprising the markets. That's when analysts thought results wouldn't actually be as good as they turned out to be.
Yeah.
And that's helped give shares a little bit of a boost. And I think it's worth flagging that actually that earnings growth has been fueling a lot of the share price rises. It hasn't all been mad speculation where investors have just been allocating these crazy valuations to companies. It has been backed up by actual financial performance. Yeah,
and because they're so important, they take up such a big part of the index. These moments when results come out, they've become very, very big moments for the market, haven't they, in terms of sentiment overall? There's always been examples of companies, having watershed moments when they release results. But now it seems, particularly with a company like Nvidia, every time we get an update on its earnings, the market is watching to see whether it can fulfill its promise and its potential. We can actually see on the next chart that we're going to show the earnings per share for each of the Magnificent Seven. So earnings per share being basically a shorthand, right, for how the company's doing, really, and the money it's making. Again, apologies if you're listening and can't see this, but basically, everything's been going great for these companies. Is the sort of short way of saying it. The trend is for all of them getting more profitable as the years go on. There's a bit of noise in a stock like Tesla, which has had a bit of a dip, but basically the direction is up. And this chart actually shows earnings from the last 5 years or so, but also into the next 3 years based on earnings forecasts. And from there, we can see basically that they're forecasted to continue their earnings growth.
They are. But I would caveat that by saying it's really, really hard to forecast what the growth's going to be. And that's the case for any sector anywhere, but particularly with big tech.
Yeah.
I think it's just because they play such a huge part in people's lives and in society. And it's just impossible to know what direction technology is going to go, really.
Of course, yeah.
And there have been these crazy predictions about what AI might do to the labor force or, people's home lives, all this stuff. Like, will we be wearing sort of AI glasses in the future?
Yeah.
And I think, if you'd travel back to the year 2000, if you were trying to predict, okay, what will everyone be doing in 10 years' time? What will be the pieces of technology we rely on? People wouldn't have come up with an accurate prediction.
And we invariably get it wrong.
Yeah.
Well, we get it wrong over very, very long periods, right? It's impossible to know for sure. But in the short term, forecasts like this that we can see illustrated here, they are based on earnings in the here and now, aren't they? I mean, we should say that. And actually, we're going to come on and talk about valuations later. And actually, the earnings that these companies make underpin high valuations, but not always crazy valuations. But just dwelling on the earnings growth for a moment, the market certainly expects them to continue to grow their earnings in the future. They are described as growth companies, and that's what that means, isn't it? Basically, they can reliably grow their earnings into the future. That's an important thing from an investment point of view, because it does dictate somewhat how they respond in relation to things like inflation and interest rates. people might remember back in 2022, these companies really fell a lot more than the market fell. And the reason for that was that we had inflation, we had interest rate rises. Those things erode the value of their future earnings. And when so much of those future earnings are actually baked into the price today, it has a sort of outsized effect. It's kind of a vulnerability of a growth company, right?
It is, I think. And I think there'll be a lot of interest in September on what happens to US interest rates.
Yeah.
So at the moment, everyone seems extremely confident they're finally going to cut them, finally going to reduce that borrowing cost, and that's good for business. But if that doesn't happen, things could, I don't know, I imagine the market wouldn't respond particularly well.
Yeah, exactly. I think one of the first reactions you might see is a hit to some of these companies. It's probably a good moment to talk about some of the differences between this group. We're talking about them as one sort of homogenous group, but actually there's big differences within those companies. They're doing different, a company like Google is doing so many different things, or Alphabet, I should say. They're not all the same. Tesla is one that stands out because that has had periods of falling revenue and earnings. The others have been a bit more reliable. Also, Apple, rising earnings per share, but not rising as fast as some of the others. There are differences, aren't there?
Yeah, huge numbers of differences. I mean, if you think they're doing completely different things, if NVIDIA making AI chips and Tesla making cars, there's loads of different pressures there. Tesla, as you say, has been a bit of the problem child, I would say, this year.
Yes.
Shares haven't done well, and that's largely due to demand issues, I think. So people haven't been buying the cars as fast as people thought they would be. Yeah. There's a lot of competition coming in from China. And it's also quite an interesting point for the company because it seems to be trying to transition out of being just a car maker into more of a tech giant. And it's sort of in this interesting phase of movement, which, I don't know, I guess with any change, there's always a bit of bumpiness. Yeah,
absolutely. And it's interesting because these companies, as described, obviously they're in the business of technology and on that sort of, front edge of technology all the time. But as you say, Tesla, for example, ultimately is going to sell cars. Apple, you could argue, ultimately sells iPhones, really. That's what drives its business. But it's assumed that they have these other qualities. They have these moats around them. They have kind of just their technological innovation, how advanced they are, how big they are, their ability to buy up smaller rivals. It makes it very difficult for anyone to truly compete with them. But that does get tested from time to time on individual members of this group. Right? Tesla may well fall out of what we're calling the Magnificent Seven, mightn't it? Because there's another company out there which no one really is talking about yet, but which may join this group.
Yes. Yeah. Broadcom.
Broadcom. A very nondescript name.
I was going to say, it's not great.
Very forgettable name, but some of the most important companies do have forgettable names.
That is true. And so Broadcom, I guess you'd probably say it's closest aligned to NVIDIA. Yeah. So it makes these chips, which have to exist in order for AI to happen.
Yeah.
I think they probably occupy different spaces in the market, though. So NVIDIA designs chips largely that are almost a bit off the shelf that lots of companies can use. Whereas Broadcom, I mean, again, a very large, broad business, as the name suggests, but it's more specialist. So it's more designing things for bespoke solutions, narrow solutions that, companies need specifically, but not all companies will need.
And lest we forget, the Magnificent Seven is a kind of buzzword that followed another buzzword, the FANGs, including a lot of these companies, but also including Netflix, famously. That's sort of fallen out of this top group of companies by size, had its ups and downs, doing quite well at the moment.
Yeah.
But it just goes to show, doesn't it, that it's not like there's anything written in stone that says these companies are going to continue to be the biggest in the world. It's just what's the biggest now.
Exactly. And it feels like the ground is always shifting, really.
Yeah.
And it's easy to get into the mentality of, well, these are the biggest companies, they're the most powerful, they're unstoppable. But history suggests that's not how these things work.
Yeah, indeed. We're going to finish with one final chart and hopefully build a picture of the sort of competing pressures on these companies from an investment point of view, and one of those is certainly going to be their valuation. The chart it shows the forward price to earnings valuation. Price to earnings being basically a comparison between their price and how much money they make, but using the earnings they're forecasted to make.
Yep.
This is distorted a little bit by Tesla. If you can see the chart, you'll see that has a huge, wild valuation of 140 times its earnings, probably more to do with the earnings side of things. But the others tend to sit in a range between about 25 times and 35 times their earnings. We're showing here the S&P 500 as a comparison. The S&P 500 overall has a valuation of about 22 times. But it's fair to say, isn't it, that they're a little bit expensive, but not crazy expensive.
I think that's fair. I suppose when you think about valuation, you're always using that price to earnings ratio as a point of comparison, really. So it doesn't tell you that much in its own right. You're using it to compare it to other companies or to the market as a whole. And that S&P 500 figure is a little bit tricky because obviously it's warped by the presence of the Magnificent Seven.
Of course.
So
to recap, that's 22 times earnings for the market overall, but including some quite highly valued
Exactly. So if you were only looking at some of the smaller companies, there would be a bigger gap between those two segments.
Yeah, and look, you've got Nvidia there. That must be up near 35 times. I mean, that is quite punchy, isn't it? I mean, yes, earnings are coming through, but I think, in the UK market, I don't know what that's on about at the moment, but probably something like 13, 14 times, something like that.
Yeah.
So in that context, in a more international context, they do look expensive. And, anyone buying them now, this is part of the answer, part of the question we want to answer today. Anyone buying them now has to take on that risk, don't they? Because these companies have to deliver on their earnings. People will say, they're priced for perfection, basically. It has to happen. And it has been happening, but it has to continue to happen for valuations like that to be justified.
I think that's fair. And also, sometimes it's not even about what the companies are saying. So this week we've seen a little bit of a wobble. I mean, it's been called a sell-off, but I don't know if that's a bit of an exaggeration.
Yeah, just a little chink, right?
Yeah, an air pocket, maybe I think I've seen it described as. But that seems to be related to this MIT report that's come out. And that was based on a survey of lots of different companies, basically trying to figure out how useful generative AI has been for their profit performance.
Yeah.
And anyway, the results weren't amazing, and the market clearly thought, oh my goodness, AI isn't going to be the next giant thing, and that caused markets to wobble. And you think in the grand scheme of things, that's one report, but it just really underlines the fact that investors do seem quite nervous. They're
quite nervous. We've had this mad run. I mean, a great run for stock markets. And when we did hit a big bump earlier this year, really quickly recovered from that. That's in the rearview mirror now. And we've just gone from strength to strength. And I think people are looking for like bumps in the road, basically, and what are reasons for things to go wrong. I mean, with these companies, we've touched on a couple of the ways they might get blown off course. Higher inflation, higher interest rates hurts them a lot. I think in general, we don't know. Two things can be true at the same time, right? AI can be a revolutionary change for all of us, and it can completely change our lives. But it might not always commercially benefit the companies we expect it to, or in the timescale that we expect it to. Because, if there's a big recession, for example, and there's sort of some quite uneven economic data coming through, who knows what happens to companies spending on AI? We're all assuming that companies out there are going to be spending on AI to make themselves more productive. And lots will and be looking for ways to do that. But if recession comes along, they might say, well, that's the spending we're not going to make now. We're going to defer it. We're going to concentrate on other things. You just don't know what that's going to do to these big companies that are relying on AI.
No, and sometimes I think it's quite useful to go back a few years and think, okay, when was there another moment like this? So if you go back to the year 2000, thinking dot-com bubble, everyone was really, really excited about the internet. And obviously that excitement was well-founded. It has completely transformed our lives. But it took a lot longer than people were thinking back then. Yeah. And that there wasn't that immediate sugar hit that the market was expecting, and that proved really, really damaging for returns in the short term.
Yeah, and there were losers from that period. that people expected to be winners, essentially. You don't quite ever know who's going to be on the right side of things in the fullness of time. Finally, for today, Jemma, I wanted to spend some time on the risks of not buying these companies, essentially. We've explained they represent a risk from a sort of index concentration point of view. You know, when the index is so dominated by a small group of companies, that does represent a risk. They're highly valued. We've looked at that as well. But if you're not going to buy them, or you want to underweight them in your portfolio, it's probably a more realistic way of going about it. You could have done that a year ago or 2 years ago or 5 years ago. They've always been, or there has always been, a group of companies at the top of the index that's quite highly valued, that people are, you know, beginning to doubt or question. And had you not invested in these companies over the past 5 years or 10 years, as we've shown, that would have been very, very, very costly. So it's a hard position for investors to be in, of taking the call against these companies, right?
It's really, really hard. And yeah, it takes us back to the graph at the very beginning. You know, if you'd sat on the sidelines, you would have missed out on a huge amount of money. I guess it just reinforces that point that we make a lot, in that it's very difficult to time the market. And often it's a bad idea to try and time the market because it doesn't work.
Yeah, and that's a really good point. I think there'll be a lot of people out there who say, I'm making a rational call on the valuation of these companies, of the concentration risk. They share certain commonalities that mean they would all suffer in certain circumstances, and I'm gonna underweight them. That is actually a timing call as well, isn't it? Because, like, you may well be right. Probably you will be right at some point. These companies are going to run into trouble. That's life. That's the world, and definitely it's the world of investing. But they can do so well in the meantime that that's still the wrong call. And that's what's so hard about this. I actually did some kind of press work and was interviewed and asked about global tracking funds. And I'd sort of said that, you know, global tracking funds are quite a good kind of one-stop shop for people trying to diversify, to be kind of immediately diversified. And in response, the journalist raised the point, said, well, what about this concentration risk? Is this surely not the time to not be doing this, not be just tracking markets, because you're going to get too many of these or too much of your money in these companies? And I guess I you know, that was my response then. It's like, yeah, but that's a risk you're taking. The market, for better or for worse, has decided they're worth this amount of money. That might be wrong, but if you disagree with it, you're disagreeing with the market, right? And that's the hard thing always to do.
I think so. And what struck me was this isn't just an issue for really active stock pickers. It's not people who, you know, poring over their portfolios, figuring out what to do. Like, this affects pretty much anyone with an ISA or a pension or wherever you keep your money, because if you're in the stock market, you're in those companies, and probably quite a lot of your money is in those companies. So it's a pressing question, but it's a tricky one to answer.
Yeah, we kind of all need them to do quite well, I suppose, unless you have completely shorted them and underweight these companies. Okay, well, that does just about cover it, I think, and it is all the time we have. So I'll just point viewers and listeners to Jemma's article, which was the inspiration for today's episode and which contains all the charts that we spoke about and a few that we didn't speak about. Please do seek that out at the Markets and Insights section at fidelity.co.uk. I'll also remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you're going to get updated content like this as soon as it is released. Give us a like if you'd like to do that, and share the episodes. It really does help people find what we're doing here. That said, Jemma, thanks for joining me.
Thank you.